lot of noise in the market right now. Asia on the front foot once again, and that's after selling off yesterday. Do you think it was just a point for investors to come in and buy a couple of stocks today when things were looking a little bit bleak yesterday? What strategy would you be putting forward? I mean, are you expecting a lot of volatility?
I think we are. And as you rightly say, I think the market's got a little bit spooked by a couple of events yesterday. First, we had the announcement about the increased cash reserves in the Chinese banks. And some people thought, well, that might slow Chinese growth. Although I think they soon got over that one. And then, of course, we had the announcement from Google that they'd be going in there and they would actually give unfettered access to Google, and they wouldn't filter out what the Chinese government had been asking them to filter in retaliation for being hacked. For having some of the disciplines being hacked, that type of thing. But again, that kind of soon blew over. I think there's the realization that the Chinese economy particularly is forging ahead quite dramatically. We have to bear in mind, though, that there is every possibility of a bubble in China, particularly in real estate prices.
This is what they're trying to avoid by tightening
Yes,
monetary
indeed.
policy.
And you know, tightening monetary policy by 50 basis points as they've done, that's a more elegant procedure than they tended to use in the past. They tend to be a bit ham-fisted in the past. So this is actually quite nice, and provided it doesn't get out of hand and really start cooling the economy dramatically to maybe growth of 3 or 4%, then I think it's going to be fine.
I think at the end of the day, Chris, investors are looking at the earnings and the numbers that we'll be seeing coming through this year. All eyes in South Africa, of course, on the retailers. Everyone's wondering how we fared in December. Shoprite came out with a trading update yesterday. First half sales up 11.9%, but the non-South African operations took a blow from that stronger rand. Sales down 4.3%.
Yeah. Excuse me. If you look at the operations within Africa itself, going very, very nicely. It's just that the rand has been remarkably strong in the past 6 months and a year. And as you translate their earnings from their various currencies back into rand, then of course it looks an awful lot worse than it otherwise would be. I think you have to take that with a bit of a pinch of salt. You have to also bear in mind that these results, in comparison with the previous interim compared to the previous interim before that, if you go back a couple of years, there was a strike, and quite a severe strike at Shoprite. So you didn't have that coming through this year to give it a bit of a boost. So this is more of a normal situation, if you like, for Shoprite, and quite a lot lower than we've come to expect from Shoprite. But nevertheless, still a very reasonable performance.
Looking at the likes of Pick n Pay with regard to Shoprite's market share here in South Africa, Pick n Pay still leading, Shoprite coming in second best.
Do you know, the former CEO of Pick n Pay, Sean Summers, said to me many years ago that turnover is flattery, profit is vanity, and earnings are sanity. And that's what you've got to concentrate on. Market share per se doesn't mean an awful lot. Yes, when you're that big, you get a lot of vying for number one position. And it's very easy to use certain different starting points to make your point and say, well, you know, we're actually bigger than Pick n Pay at this point in time, or Pick n Pay say, well, we're bigger than Shoprite. In fact, you know, it doesn't really make an excuse me, it doesn't make an awful lot of difference. They're both round about the same size. No doubt about it, Shoprite has been taking a bit of market share away from Pick n Pay, from Spar, and from Woolies in the past year or so. But yeah, I would rather concentrate on the sustainable profit growth from all of these companies.
Looking at Shoprite, we saw a bit of director dealings during the month of December, which came as quite a surprise to many investors out there.
Yeah, while he was on, he cashed in 249 million rands worth of shares, £250 million rands worth. I mean, that's a huge figure in anyone's, and he's still got a lot left. Look, no one's begrudging Whitey his spoils. He's done an incredible job with Shoprite. But he's 63 years of age now, and maybe he's looking over the horizon 2, 3, 4 years down the track and thinking, maybe I must tuck away some money right now. He's maybe also thinking, and this maybe is what's coming out in the results now, that the retail sector is looking a little bit weak. And that's not surprising, given the fact we've got very high unemployment, and that's not getting any better. We've got the impact of the National Credit Act, and we're not seeing a particularly robust response to a reduction in interest rates. So, you know, a bird in the hand is worth two in the bush.
If you had to pick one of those food retailers, which would you go for? I mean, Shoprite, clearly one of the loved stocks purely because it's got that African footprint. Yeah,
look, I like Shoprite. It's a great operation, and I think it's probably a bit full in terms of its rating. Now, I would rather go for Pick n Pay. I think we've still got to see the benefits of their restructuring taking place, and we'll see that from this year onwards coming through. But it's a very difficult choice because they're all really world-class operators.
Love triangle between FEMSA, Heineken and SABMiller, and of course SAB decided not to pay too much for South American assets. We know that SAB already has a footprint in South America. Now Heineken and FEMSA have teamed up, and of course Heineken, the first time that it's really entered emerging markets.
No, look, Heineken's been in emerging markets for a long time. It hasn't necessarily been in the South American region before. FEMSA was the big prize, the big Mexican operation. Tremendous operation. Bear in mind that Heineken isn't buying its Coke assets, only the beer assets, and the Coke assets really they're phenomenally good. FEMSA wanted a partner in which it could have a direct stake, and it'll have about 20% stake in Heineken, which is fantastic. It means it's going to participate in Heineken's future growth. Heineken also will, when it takes FEMSA's 41.1 million hectolitres on board, that'll propel them into third place, only a little smidgen behind SABMiller. But they also said that in terms of revenue, it will actually be bigger than SABMiller now. So it'll put them into second place behind InBev. So Heineken's coming back fighting big time.
Okay, Chris, give us your strategy for this year. What would you be doing? We've got an awfully strong rand at this stage. So many investors complaining about that because it is hampering a lot of sectors, a lot of profits as well. Are you going for defensives? Are you being brave and going along with the resource commodity bandwagon?
Look, I think the resources are still got a long way to go. We're still very much in the long-term commodity super cycle. It's probably more of a stock pickers market than it was last year. Having said that, we have to see what comes through in terms of earnings. Earnings are going to be critical this year. And the retailers are suggesting the earnings growth from that sector particularly is not going to be that great, at least for the first 6 months. And I think that's the point to make. The first 6 months are probably still going to be quite tough. Second 6 months, I think, probably coming through an awful lot stronger from a variety of companies out there. So, we are kind of high, 17.5 PE. It's historically quite high. Maybe one could just be sitting back a little bit and surveying the landscape and seeing what actually happens on the earnings front.